Can you see my screen from where you are?
Yes, please.
Okay. Let me see. Okay, so we have the first mock. So we'll randomly pick some of the questions and discuss through all the three mocks. We'll, we'll look at some of the questions. Any of them that you have issues with whilst going through the video, we'll just address it. Okay, so for Dennis, I know you are here to complete your study on VAT. Elsie, where are you lacking? Do you have any area of the syllabus you are yet to complete?
Yes, the last two, 19 to 23 and chapter 24.
19 to 24.
No, yeah, 19 to 24.
That's a lot. And
Hello?
yes, is it on VAT? Let me confirm that.
Yeah, I think it's 3 hours. So I'm not done.
I think 19 to 24 is operation plus VAT.
Corporate tax and VAT. Then you have a lot to do. Because corporate tax is a major area. VAT, in fact, they are all very important. And you know, the C part, one of the questions will really be on corporate tax.
Yes,
The B2, you have one case study on that. So you have about the minimum of 25% beside the A part. In the worst case question, the B part, you have about 10 marker question. That's one case study on that. And then the C part, you have a 50 marker question on corporate tax. So that's 25%. Then the A part two, you may have some multiple choice questions on both, like corporate tax, VAT. So you are uh, behind about 40%. Yes. Then when are you completing it?
Oh, next week.
Next week.
Yes.
This month is almost gone. You need to finish and come and do your revision and make sure you are well grounded.
Yes.
Mm, okay. All right. So question number 4 here. About VAT. Question number 4 is about VAT. And the requirement was that we have to indicate on the relevant boxes in the table below. the number and amount of monthly payments on account of VAT which T Limited must make in respect of the year ended 31st December 2020 prior to submitting its VAT return for that year. You've all not read on VAT, so you may not know exactly what this question is about or what the principles are applicable to such a question. Because here you were told that this company is registered for VAT and uses the annual accounting scheme. So under VAT, we have what we call the annual accounting scheme. We have other schemes like the cash accounting scheme. We have the flat rate scheme. And the annual accounting scheme, normally VAT is supposed to be filed or paid on quarterly basis. But if you are using the annual accounting scheme, that scheme gives you some flexibility. You will not do your filing of the return on quarterly basis. The filing of the return is done once a year. That's why we call it the annual accounting scheme. You file your VAT return once a year. So at the end of the year, that's when you file your VAT return. However, payment of the VAT is not only done after the end of the year. We have to do what we call payment on account. Right? The difference between payment of the VAT and then the filing of the return. Payment is like you paying the amount involved. Filing, you submit the document in support of that payment. Right? So under the annual accounting scheme, the law says you pay 9-month installment. You do 9 monthly what installment, and the installment payment starts from the 4th month of the relevant year you are trading. So if your accounting period starts from January to December, the 4th month of that year will be what month?
To be April.
It will be April. Yes. So if your trading period is January to December, then you have to start doing the quarterly installment from April up toward December, which will give you 9 months. So you are doing 9 months installments, and those installments you do should be 10%. The amount you pay on installment basis should be what? 10% of the VAT you paid last year. So if you are in, let's say, 2021, the amount you pay for 2021 as installment should be based on 2020 what VAT paid. So the VAT you paid in 2020, you paid 50,000 in 2020. You take 10% of that 50,000, that will be 5,000. So it means that in this year, in the current year, which is 2021, starting from April, you'll be paying 5,000 over the 9 months. That's from April to December. So at the end of the year, you will now know the exact amount to be paid for 2021 minus what you paid on installment. The balance will be what will be paid together with the document. When you are filing, then you pay your the balance. So that's how the annual accounting scheme works under VAT. Then we have the cash accounting scheme. Now with the cash accounting scheme, VAT is payable on cash basis. That means we will only pay VAT when cash is what is received. If you sell on credit, you don't pay any VAT until the customer comes to pay you cash, right? So the tax point or the VAT point for cash accounting scheme is when money has been received or payment has been made. So you can also claim input VAT on expenses or purchases. So if you also incur those expenses or you bought goods and you don't pay cash to your suppliers, you can also not claim input VAT until you finally do the payment before VAT can be accounted for. Right. So, okay, with the annual accounting scheme, some of the advantages are that it gives you enough time. It saves you some time, unlike the normal VAT scheme where we do the payment and the filing on quarterly basis. You see that you always have to spend time doing that on quarterly basis. But with the annual accounting scheme, it's just one, so it saves you some time and costs. Right? Again, the possibility of you defaulting with the deadline is minimal because you file it just once. But with the normal scheme where you have to file every quarter, you are likely to go, that means within a year you have to file it 4 times. You can default one of the 4 quarters, right? But with the annual accounting, because it's once, the possibility of you delaying is minimal. Right, and with the annual accounting scheme too, we do the installment based on the VAT paid in the previous year. So at least you will be able to know ahead of time how much will be going into VAT payment in the current year. Since it's going to be based on the previous year, you can forecast and know. Because you know the previous year VAT paid, and a percentage of that is what you'll be paying this year on monthly basis. So you can factor that into your budget for the year, since it's known. And then we have the flat rate. With the flat rate. By the way, do you know the standard rate for VAT? Do you know the standard rate for VAT? Or because you've not read on it, you have no forgotten that. Okay, so the standard rate is 20%. Okay, so we have zero type of supply that can be made under VAT. We have standard rated supply, and standard rated supply, they goes with a VAT rate of 20%. Then some of the goods may be at a reduced rate. So if you see any transaction that is at a reduced rate, the rate you use will be 5%. So if they said the item is at a reduced VAT rate, we'll use 5%. And then we have zero rated supply. Zero rated supply, that the VAT rate on such goods is 0%. Right? It does not mean the goods are not accounted for under VAT. They are subject to VAT, but the rate we use is 0%. So virtually you will not pay any VAT. But when you are looking at the limit for VAT registration, if you want to check whether you meet the limit for VAT registration, we consider both standard rated supply and zero rated supply. Then we have exempt supply. Exempt supply, they are outside the scope of that, so they are not even captured for registration purposes. They are not also considered when we are filing our VAT returns. Right. So I explained the annual accounting scheme. So we can answer question number 4. So what would be the answer for question number 4? From the explanation I gave you on the annual accounting scheme.
Monthly payment to be 9 months.
Yes.
And the amount to be 7350.
785.
7350. Which is
735.
10% of the previous year.
Okay, so
Of the previous year is 2019, or
yes, previous year should be 2019.
Yeah, sure.
And 2019, the VAT we paid there was 47,700. So 10% of that will be 4770. Is that right?
I think so.
Yes. right? Well, that 10% should be taken on the previous year's VAT, and we are to do this for 2020, so the previous year will be 2019. Okay. Um, okay, let's look at question number 5. Question number 5, we were told that we are to determine the amount of else deductible pre-trading expenditure in respect of the year ended 31st December 2020. Right, so here you should know the condition when it comes to pre-trading expenditure. Pre-trading expenditure. What do you know with pre-trading expenditure when it comes to tax? Expenditures.
I know entertainment. Okay.
Entertainment.
Entertainment isn't part. Isn't deductible.
Okay, so that one is a general issue applicable to all expenses, whether the company is, um, whether the expenditure is during trading or pre-trading. We know for expenses to qualify for deduction, it should fall within a certain scope, and entertainment is one of those which will not allow, except, but that one too, there's a qualification of it. Which some are allowed, some are not allowed when it comes to entertainment.
Oh, okay.
I
Yes,
think the payment of employees.
yes. So employee entertainment is allowable.
Okay.
Yes, but any other form of entertainment is not allowable. Okay, so that's when it comes to trading issues. Then we have VAT issues. Now, with VAT issues, when it comes to entertainment, we allow entertainment for employees and overseas customers. When you are entertaining your overseas customers, let's say you have customers from Ghana, okay, visiting the company in the UK, and you spend some money entertaining them for VAT purposes. That entertainment expenditure qualify for input VAT. You can claim input VAT on entertaining overseas customers as well as what employees. But when it comes to other, if it's not VAT issue, like the question we are about to solve, this one is not related to VAT. It's not about input VAT on expenses. It's about expenses we can claim against our trading results, our profit or loss account. That one will only allow entertaining what employees. The rest are not allowable. But when it comes to input VAT, right, for VAT purposes, we can claim input VAT on entertaining overseas customers as well as what employees. The rest we can't. Do you get that? Okay. Then, yeah. So now we get the issue with entertainment, right? And but I want they mentioned the word pre-trading. Pre-trading means that the expenditure was incurred before what trading. Is that not it?
Yes.
Yeah. The expenditure happened. These are expenditures incurred before we started trading. Because if you look at the introduction, this company started trading on 3rd January 2020, and the company incurred the following expenditure prior to the date they commenced trading. They commenced 3rd January 2020, and they said prior to 3rd January 2020, these expenditures were incurred. So these are expenditures that happened before the company started trading. And there's a condition for expenditures that happen before what? Trading. We have to first establish that condition before we will now go check the expenses and see whether they are deductible or not. So for pre-trading expenditure, they must fall within a certain number of years after the date we commence trading. Can you recall the number of years they must fall within? to the date of trading. They should not be more than some number of years.
It shouldn't be more than 7 years.
Yes. Yeah. So for pre-trade expenditure, they must be within 7 years to the date of commencement of trade. If the expenditure has been incurred for more than 7 years before we started trading, we will not, whether it's allowable per the normal rule, so far it's not within the 7-year interval, we will not deduct it. Okay, so for pre-trading, don't just look at the expenditure, also check whether the expenditure fall within the 7-year interval prior to commencement of trade. Okay, so we take the one after the other. The first one was incurred on 30th November 2012. That's initial market research. Right now, initial market research, that expenditure should be allowed. But what we are dealing with pre-trading, let's also check the dates. Does it fall within 7 years to the date you commence trading?
No.
Yes, so this was 2012 and we commenced trade. So in any case, we should look at expenditures from 2020, is it 13?
So it's look from 13, January 2013.
January, somewhere January 2013. Yes, and this one was before that, so it's outside the 7-year period. Okay, so even though market research itself is an allowable expenditure, because we are doing with pre-trading, the number of years show that it is outside the interval for pre-trading expenditure. So that's why we will not allow it. And then we have the other one, research into competitors. This one was 2015. Yes, it's within 7 years. And the research into competitors is an allowable item. So allow, so the 12,000 will be allowed. Then we have July 2019, entertaining potential customers and suppliers. Is it allowable?
It's not allowed.
We will not allow. Even though it's within the 7-year interval, the item itself is not something we can allow. We will not allow entertaining suppliers and customers. Right. And then we have 2019, donation to a local school fair in exchange for advertising. Yes, it's within 7 years and the item is allowable. So we have the 12,000 and the 2,000 being allowable. So in that we should be having 14,000 as the total amount.
Jonathan, please, I have a question.
Okay.
The donation to local school fair, if advertising wasn't there, would it be allowable?
Because so far is to a local, so normally if it's to a local charity or local organization, we have to allow it. It's allowed. And we have another one, we call it gift. Okay, gift, we have gift to customers, right? Now for gift to customers, we said it has to meet about 3 conditions, right? When it comes to gift to customers. Now this donation, I don't think the local school is a customer. This is something like a corporate social activity or responsibility. And the word being local school should be allowed. That one, there's no really a condition, right? But when it comes to donation to customers, for customers, that one has a condition that it must not be more than 50 per recipient per year. It must be in a form of advertisement, and it must not be food, tobacco, or drink.
Okay.
Right. So
Yes.
yes. So if it's a gift to customers, then we have to ensure that we meet these conditions. That is not a food item. Each customer is not getting more than 50 per year. And what again?
It must be in the form of advertisement.
Yes. Yes. So those are the conditions. If that donation or gift is being made toward a customer. Okay. But something to like a local school like this, I don't think in the absence of the advertisement, it should be disallowed. It's still allowable.
Thank you.
You're welcome. Then we have political donation. That one, there's no condition, automatically not allowable.
Oh, okay.
Political donation is not allowable. Whether they add the word for advertisement or whatever, it's not allowed. All right. Um, I don't think you have problem with class 4 NIC computation. That's to calculate class 4.
So,
On what figure do we calculate class 4 NIC? What figure do we use to calculate class 4? Or class 4 is calculated for which people?
Sorry, for which?
For which people do we calculate? Or for which class of taxpayers do
The
we calculate?
self-employed.
Yes, so for the self-employed. And it's on what figure? What item?
Adjusted trading profit.
Yes, so it's on the adjusted trading profit. Adjusted trading profit. And you have to ensure that that trading profit relates to the tax year you are dealing with. There are times where the profit in question may not relate to, let's say, 2021. So you have to do a base of assessment to determine the profit that will be assessed in what 2021 tax year. Especially if you are dealing with a new business. It is so the company commenced trade on this date and it's new. Then you have to do basis of assessment to know how much of the profit will be assessed in 2021, and that's what you use to do your class 4 NIC. So, for example, in this question, you said P has been trading for a number of years. At times when you say trading for a number of years, that means the person has been trading for long ago. And you will not be given the date the person commenced trading. So in that case, there's no need for you to do basis of assessment. You just look at the end of the year to determine the tax year in which the profit fall. So like in this question, this guy have been trading for a number of years. We were not giving when he commenced trading. But they said what? Her tax adjusted trading profit for the year ended 31st May 2020 was 53,150. And for the year ended 31st May 2021 was 50,350. And we have to calculate class 4 for 2021 tax year. Here we don't need to do basis of assessment because we don't even know when the guy commenced trading. Because for you to do the assessment, you have to start from the first tax year, where you look at the day the person commenced up to 5th April. That will be your first, the period for the first tax year. You do your working, then you move on to the second tax year. But in this question, that is not applicable. And we know after the first tax year of trading, the next rule is to follow the accounting date, wherever the accounting date falls. The tax year in which the accounting date falls, all the profit will be assessed in that particular year. So for this question, the accounting data I'll be given are what you are going to use. So first we look at year ended 31st May 2020, and that will fall in May 2020 will fall in which tax year? Yes. So what it means that we've already seen the profit will need for 2021 for the computation. May 2021 will be the next tax year, tax year 21, 22. So we cannot use the 5350. We have to rely on the 53,150 since that's the amount that falls in the current year. Right. So you just have to compare this amount against the limit. Yes, and I hope for the limit you get them from the table. This model, I think the upper limit is 50,000, lower limit is 9,500. So you take up to the upper limit 50,000 minus the lower limit of 9,500 at 9%, and then the amount above the upper limit, that's the 53,150 minus the 50,000 at 2%. So we'll be having something like this. Question number. We should have something like this. Okay, so here they did the upper limit, then they did the first. They approved the 2% first before 9%. Okay, if I'm solving, I will do the 9% limit. The amount I go for the 9%, then I'll move on to see those above the upper at what 2%. But whichever approach you get that you are comfortable with, follow. This one too says the corporate tax. So we have to indicate whether true or false. Corporate tax is a direct tax on the turnover of companies. Is it true or false? So, corporate tax is a direct tax on turnover of companies. True or false?
True.
You say true.
I know it's a direct tax, but I don't know whether it's on turnover or on something.
How you've gone through your corporate tax?
Yeah, I've gone through it.
How do you calculate the corporate tax liability? You multiply I think it's 9, the rate is 90%, right?
Yes,
Yeah, so you multiply that 90% by what figure? By what figure?
TTP.
TTP. Yes, and the full name for TTP is what?
Total.
Okay, so total taxable profit or taxable total profit. Right, so that's how it's calculated. The rate by the TTP and not on turnover. The difference between turnover and the TTP. Turnover is like the sales. It's the sales you make. And you know, from the sales with less expenses, what have you, we get adjusted trading profit. Then we may add other non-trade income like chargeable gains, interest receivable, property income. Then we get our total profit. With less qualifying charitable donation, then we get TTP. And it's on that TTP we multiply by what? The 19%. Right? So it's false. It's not on the turnover. Then the second one says that NIC is a direct tax suffered by employees, employers, and the self-employed on earnings. Is it true or false?
It's true.
Yes, so it's true. NIC is served by employees on their earnings. Employers also pay NIC on the earnings of employees. The self-employed also pay NIC on their earnings, which is the profit. And that inheritance tax is a direct tax on transfers of income by individuals. Is it true or false?
It's false. The transfer of value.
Yes, so it's on transfer of value. Yes. VAT is a direct tax applied on
Yes.
goods and services.
It's false.
If false, it's an indirect tax. It's an indirect tax. Okay, so let's look at question number 11. Now, question number 11 says, let's look at the requirement. It said, what amount of NIC, what amount of inheritance tax was payable as a result of C's death in respect of the cash gift of 500,000 to a nephew? So what it means that we have to calculate death tax. You have to calculate death tax on this 500,000. Death tax on the 500,000 you give to the nephew. So if you go back to the content of the question, we're told that C made a cash gift, 300,000 to the nephew. That was in April 2015. Okay, so we have 300,000. Then again, she made another one to the nephew in May 2016. Both of these amounts are stated after deducting available exemption. So that these figures are after all available exemption. She died on 31st October 2020. And we have to calculate the death tax on these 500,000. Calculate the death tax on the 500,000. Okay, so you know, for death tax to be applicable on lifetime transfer, so these are lifetime transfers that have been made. For this lifetime transfer to be subject to death tax, we said death must occur within a certain number of years for the transfer to be subject to death tax, right? So what is that year interval? Or for the transfer to be exempt from death tax, the donor should survive for how long?
7 years.
Yes, so if you survive for more than 7 years, these transfers will be exempt from death tax. However, where death occur within 7 years, then we need to tax. So we can see that death occur within 7 years. The one we are dealing with, the one we have to tax, was made on 31st May 2016, and death occurred 31st October 2020. So that's about some 4 years and some months. So since he didn't survive for more than 7 years, we are going to tax it. Now, this after all available exemptions, so it becomes our gross chargeable transfer. We don't need to less any exemptions again. There will be no annual exemption because they say it's afterward deducting available exemptions. right? So we pick this 500,000. Then the next thing will be to consider our nil rate band. We are taxing it in a year of death, October 2020. So that's in the current year. That's when death occurred. So what the nil rate band in the current year is 325. And we said that anytime we quote the nil rate band, we need to consider gross chargeable transfers 7 years back. Now you are dealing with, even though you are taxing it on in the year of death, you always have to quote the date the transfer is made, 31st May 2016. So now we need to look back. We look back within 7 years up to 31st May 2016. Was there any gross chargeable transfer? Was there any gross chargeable transfer within 7 years to 31st May 2016?
Just the transfer to her niece, the cash gift,
Yes, and that's how much?
300,000.
Yes, so that 300,000 is within 7 years up to the particular transfer we are dealing with. So this 300,000 will reduce the nil rate band available. We said the nil rate band is 325,000. So you reduce the nil rate band of 325 by 300,000. That will be left with 20 what? 25. That will be set off again this 500,000. So we can see from here, question number 11. Right, so we quoted the nil rate band. We have the gross chargeable transfer falling within 7 years to that one, and that's 300,000. Okay, don't forget, all these are paid. All the transfers we are doing, they are paid, and they became chargeable because they occurred within 7 years. Because this one, which was made in 2015, also became chargeable. Even though it was paid, it became chargeable because the pen didn't survive for more than what, 7 years, right? So when we set off this, we get 25,000 remaining, and therefore we have 475 to the tax at a rate of death tax. So at a rate of what? 40%. So if it's 40%, we have 190,000 as the tax. Yes, and don't forget, where lifetime transfer is being subject to death tax, we need to consider taper relief. We check for taper relief. So on the taper table, you look at, so first we check the pen survived for how many years. May 2016, death occurred on October 2020. So that's 4 years and some months. So that'll be 4 to 5 years. So if you go to the taper table, which is on your tax table, 4 to 5 years of survival will give us what? 40%. So we get this. So this 40% is not the same as the rate we use to get the liability. That one from the table, based on the 4 to 5 years survival, we have to use the 40%. And that, when you apply the 40% of 190, you get 76, and the amount of tax to be paid on death will be 114,000. 114,000. So let's see the B part of this. Let's see if not gone to the VAT. Let's see. To the VAT for this one. So we are going to solve this one. The VAT question here. If I explain and you go to the video, you will recall some of these discussions. Okay, so we are using this case to answer question number 26 to 30. And the first requirement here is that from what date would A have been required to be compulsorily registered for VAT? From what date would this company or this business be required to register for VAT compulsorily? Okay. Now, there is a limit for compulsory VAT registration. There's a limit of sales you have to meet that the law will require that you have to apply and get registered and start charging VAT. And that limit is 85,000 sales. So your sales must hit 85,000. I think that 85,000 is on the table. You must hit 85,000 in terms of sales for you to be required compulsorily to register for VAT. So that's what we need to check here, whether this company, at what point has the limit been met. Now, if you are using historical sales, when you hit the limit, you have 1 month after the month you hit the limit to do the notification, and then you are registered at the beginning of the following month. So for example, let's say you hit the limit at the end of January 2020. So you have within February, you have to use February to do your notification, and then you'll be registered from 1st March and start charging VAT from 1st March. So that's how the registration based on historical sales applied. We also have registration based on future sales. That one you don't need to wait. When you foresee that at the end of a particular month you hit more than the limit, you apply for registration at the beginning of the month you have the expectation, and your registration is effective at the beginning of the very month you expect to hit more than what the limit. So if you expect as at 1st January that okay, by the end of January I'll hit more than the limit, you apply for registration within January, and your registration is deemed to be effective from 1st January, not the following month. So that's on future sales. But for this question is based on historical sales, because we have the historical transaction here. But let's go through the content and see what we do here. So A commenced trading on 1st January 2020. Her sales since commencement has been as follows. So these are the sales since it commenced trading. January to April, per month we are getting so much. May to August we are getting so much. September to December, per month we are getting so much. And the above figures are stated exclusive of VAT. Lisa only supply services, and these are all standard rated for VAT purposes. Lisa notify her VAT to compulsorily register for VAT by the appropriate deadline. So I think this information so far can help us answer the first requirement. So we don't need to go further. We want to know from what date would this company be required to register for VAT. So I think the sales there are what we are going to rely on to check when the limit is what or has been met. So we know from January to April each month we are getting 7,500. May to August each month we are getting 10,000. So let's accumulate and see. So from January to April, how much are we going to make in all?
Maybe 7,500 times 4 months.
Okay, and that will give us, I think, 30,000. Okay, then from May to August to will give us how much? Each month is 10,000. So May to August will give us how much?
40,000.
40. So as at the end of August, what will be our total sales?
70,000.
So we have 70,000 as at the end of August. Then we continue. So small, let's build up to the 85,000 limit. Then we come to September to December. Each month we are getting 15,500. So we have to be adding it one by one. So far we have 70,000 as at August. So if you add September sales, how much will you get?
We'll get 85,500.
85,500. Yes. So, and we know the registration limit is what? 85,000. So here what it means that the limit have been exceeded at the end of September 2020. You get that? It have been exceeded at the end of September 2020. So what it means that since we hit the limit at the end of September, by 30th October, you have to do the notification. Inform the tax authorities by 30th September, and you are registered from October. Then we have November, right? So you are registered from 1st November. So this company or business will be registered from 1st November, and will start charging what? VAT. Right. So that's how the registration will be determined with this question. So that answers question number 26. So it's 1st November 2020. Then 27. What amount of pre-registration input VAT would Alisa have been able to recover in respect of inputs incurred prior to the date on which she registered for VAT? What input VAT? I mean pre-registration input. So this is about pre-registration. That's input VAT incurred before registering for VAT. So normally when you are in business and you are not registered for VAT, when you buy from your supplier, the suppliers will charge you VAT. But because you are not registered, you cannot make a claim for that VAT your supplier charged you. But there's a rule that after you become what? Registered, you'll be able to go back and claim those input VAT you paid when you were not registered. But there's a condition. When it comes to services you paid for, which you incur VAT, you can go back 6 months. For services, you can go backward 6 months to claim. So it means that the service should not be incurred for more than 6 months up to the date of registration. And then for goods and fixed assets, the goods must not be bought for more than 4 years. So they should be within 4 years period up to the date of registration. 4 years interval. And the goods must not be sold. Okay, it can be goods or fixed assets. They must not be sold as at the date we are registering for VAT. So if they are even within the 4 years, but as at the date we are registering, they'll be sold out, right? You cannot claim the input VAT. We have to see the goods in stock as at the date of what? Registration. Okay, so let's go to the question and see. So we take the next paragraph here. They said for each of the 8 months. Okay, so I think we'll get that information from this portion. For each of the 8 months prior to the date she registered for VAT, she paid $240 per month. That one is inclusive for website design, and $180 per month exclusive for advertising. I think all these are qualifying expenditure for input VAT. Both of these figures are standard rated. for VAT purposes and relate to the business activity after the date. What it means that she have been incurring these expenses 8 months before he registered, and she continued to incur them after registration. Okay, but per this question, we are concerned about the prior or pre-registration. So we know pre-registration we can only go back as far as how many months? 6 months. Even though he incurred this for 8 months before he registered, we cannot claim all the 8 months. We can only claim what? 6 months, right? Some of the expenses. Okay, so these are the expenses incurred. Okay, they are the expenses incurred. So who will determine the VAT, the input VAT on those expenses? So the first one, we have 240, which is for website design, and that one is inclusive. So how do you get the VAT component of the 240? What is the VAT component of the 240? Come again.
Is it 20%?
Yeah, we know that the VAT rate is 20%, but we're told that this 240 is VAT inclusive. Is inclusive of VAT. So how do you get the amount of VAT when the figure is inclusive?
So I think you.
Yes. You know, if okay, let's say the cost of the item is 100%, right? So if they said inclusive, that means they've added the 20% to the cost or the selling price. So that will give us how many percent? 120%. Okay. Now you are looking for the VAT component, which is 20% of a figure which is 120%. Right? So if they said the figure is inclusive, that means that figure is 120%. Then you determine 20% of the 120. So 20% divided by 120 will give us 1/6. So in short, where they said a figure is inclusive, to get the VAT amount on it, multiply the figure by 1/6. Just take it that way. You multiply the figure by 1/6 when it's stated what? VAT inclusive. Do you get that? Yes. So for the 240, we'll multiply it by what? 1/6, and that will give us the VAT. But also for 6 months, so you now multiply that whatever result you get by 6 months. Then the other one, website design, that one is 180 per month and it's exclusive. So that one you just apply 20% straightforward. 120 by 180 by what? 20% for 6 months. So multiply by what? 6 months. Okay, and when we do so, we should be getting, that's question number 26. 27, sorry. So that's what we are getting. So for the website design, is 240 for 6 by 6 months times 1/6, and that gives us 240. Advertising is 180 for 6 months. Each month we are having what? 20% of that. And so the total pre-registration input value we can claim here is 45456. Okay, then let's see number 28. Number 28 says, what is the maximum amount of input VAT which Alisa can reclaim in respect of her motor expenses for the quarter ended the first month 2021? So we input VAT on motor expenses. So let's look at the motor expenses here. Input VAT on motor expenses. So I think that one will be this paragraph. So they said after registering for VAT, he purchased a motor car on 1st January 2021. The motor car is used 60% for business mileage. Okay, and then during the quarter, she spent 456 on repairs to the motor car, right? So these repairs will qualify for input VAT. And then 624 on fuel for both business and private mileage. So we also spend so much on fuel. The relevant quarterly scale charge is 290. All the above figures are inclusive of VAT. Okay, fine. So that's the information we need to calculate our input VAT on motor expenses. So the question is about input VAT. So the motor expenses here, we have the fuel expenditure and then the repairs. They are the motor expenses, and those are the figures we are going to use to calculate what input VAT. Normally, you see the quarterly scale chart that I'll be giving here. We use quarterly scale chart to calculate output VAT. We use that to calculate output VAT. Now, the question was only asking of input VAT on motor expenses. So we'll not do anything with the quarterly scale chart. But assuming they said, let's say the VAT, the net VAT we can claim, then in that case we have to offset input and output on these motor expenses. But since the question specifically stated that input VAT, so we only focus on the items that will qualify for input VAT with regard to these motor expenses. And when it comes to the input VAT on the motor expenses, you ignore any private use of the car. It has no effect. Private use of the car has no effect on the input VAT you can claim on the expenses. The only effect is that we have to calculate output VAT, which we use the scale charge because of the private use. That's why we're giving the scale charge, which we use to calculate output VAT. But like I said, we are not calculating the output VAT because the question is only asking for the input VAT. So we only use the figures that will go for the input VAT. Okay. And then again, when you purchase a car, assuming we're giving the purchase price of the car, that purchase price cannot qualify for input VAT because of what the private use. No proportion of it will qualify for input VAT. But for the expenses of the car, they will fully qualify for input VAT, whether there's a private use or not. Right. So these figures are they? Yes, they say all the above figures are inclusive. Right. So there's 456 by 1/6, 624 by what? 1/6. That's 28. Okay. So each of these will go for 1/6. So in that case, we can add the 2 and multiply by 1/6 to give us 180. Number 20. Number 29. You have to complete the following sentence by matching the correct due date and payment method into the relevant target area. And here we're told that Anissa had to pay any VAT liability for the quarter ended March 2021 by, so we want to know by what date are we supposed to pay our VAT liability and by what method. Okay, so the method for payment of VAT liability is electronic. So the method is electronic method. Then by what date? Now, for the date, VAT liabilities are paid by the 7th of the second month after the end of the quarter. The 7th on the second month after the end of the quarter. Now, the quarter we are referring here ended 31st March 2021. So what will be the second month after that quarter? Will be May. If the quarter ended March, second month after the quarter ended will be May. And that will be 7th May. That will be 7th May. So we have 7th May and an electronic method. Number 30, that we have to identify by clicking on the relevant box in the table below which of the following items of information is not required to be included by A on a valid VAT invoice. Which of these will not be included on an invoice? One, they said the customer's VAT registration number, an invoice number, customer's address, a description of the services supplied. Right, so which of these will not be included on a valid VAT invoice? Are you here with me?
Yes, sir.
Mm-hmm. Is Elsie also around?
Let me check. Yeah, she's around.
And I hope she's listening to us. Or she has just joined and gone to sleep. Or doing something else.
Jonathan, please, I'm here. I'm listening.
Okay. So we are answering question number 30. We want to know which of this information will not be included on a valid VAT invoice.
The customer's address.
Okay, what about Elsie? What's your opinion?
Jonathan, please, I think I'll contribute better after I learn the VAT.
After you've gone through the VAT.
Yes.
Okay. All right. So yes, is the customer's invoice number. When you are giving your VAT invoice to a customer, you don't need the invoice number of the customer. When you are giving your VAT invoice, it's you, the supplier, your VAT invoice number that will be there. The description of the goods, the address of the customer, right? But you don't need the invoice number of your customer. You don't need that. Okay, so we can take another set, and maybe in the next set, let me see, number 2. Let's see if we can walk through the C part of this one. So let me go to the C part. Okay, so mock 2 section C, and the first question here is on Sarah. Okay, so I think in solving this, I have to share the solution on the Excel template. Let me get that one. Okay, so on Sarah, so this is a 10 marker question. We have A and B. The A part is we have to determine whether or not there will be an overall saving of tax and NIC contribution for the year in question if Sarah incorporated business on the beginning of this tax year. So we have to check whether there will be tax savings if the business has been incorporated. And note that you are expected to calculate the income tax payable by Sarah plus 1 NIC payable by Sarah and also payable by the new company and corporate tax liability of the new company. The new company will not be entitled to NIC annual employment allowance. You know, when it comes to the NIC, the company or the employer, when it comes to the employer NIC or class 1 employer, after they calculated that employer NIC, the less, I think, 4,000 is on the tax table, right? So I think they said that one will not be available. So if you calculate the class 1 employer NIC, you don't deduct the employment allowance. You should assume that the rate of corporate tax remain unchanged. Okay, so the main issue here is to determine if there's going to be what overall tax savings if the business is incorporated. So let's see what is here. Okay, that Sarah is currently self-employed, and if she continues to trade on self-employment basis, her total income tax liability and NIC for the year will be so much. So here you were giving the liability if we continue to trade on self-employment basis, right? So currently, she is self-employed, and we're told that this is the liability she pays under self-employment. Okay, so that means the next part will be that she wants to incorporate the business. So if she incorporates, that means it will now change from self-employment into what? A limited liability company. Okay, however, Sarah is considering incorporating her business from the beginning of the year. The forecast profit of the new company for the year will be 50,000. This before taking account of any director's remuneration. Okay, so that remuneration that any Sarah will pay to Sarah, this profit is before that amount. Sarah will pay herself remuneration of 30,000 and a dividend of what? 10,000. The balance of the profit will remain unwithdrawn within the new company. All right, so that's what's happening here. So from this information, we have to calculate the new tax and then compare to the tax we're paying under self-employment. Okay, so don't forget, under the new option, Sarah is an employee of a new company. So Sarah will pay, as an employee, will pay your normal income tax, will pay your relevant NICs. Now the company, which is now the new company you form, will pay some NIC on behalf of Sarah. The company will also pay corporate tax. So those are the issues we have to look at. So first, we deal with Sarah as an individual. Her income tax and the NIC should pay based on her income. She's going to earn salary of 30. She will earn salary of 30,000 and dividend of what? 10,000. So you can use that to calculate her income tax liability and the NICs. So let's see the approach here. Okay, so we are looking at block 2 on Sarah. Let me see. Okay, so I think this should be block 2 on Sarah. Okay, so you have Sarah here. So first, from the information we gathered, income tax payable by Sarah. She's having salary of 30. So you play with this template so that you get familiar with it before the day. We also have dividend of 10,000. We take off our PA, we get a taxable figures. So right, we tax the non-savings. So we have 7,500 at 20%. Then for dividend, we have 10,000, but we know 2,000 will only go for 0%. The remaining dividend also within the basic band at 7.5%. So this is the income tax Sarah is going to pay. Okay, so we should be able to apply the formula. Okay, so this one, I hope we know how to do. Just put the equal sign equal to this amount multiplied by 0.2, and that's how we got that. Right, so I hope by now we all know how to apply those. Okay, so and then you sum, and summation here, I believe you cannot use auto sum like I did here, but you can say here should be equal to, we are summing from here, so it should be equal to this amount. So here you can use the plus sign plus this one plus this one, and then we end. So you can do it that way if the auto sum will not work with your template. Okay, so that's our liability here, and we move forward. That's the income tax Sarah will pay, and then we also say Sarah as an employee will pay some NIC. So we have NIC employee. So this is what Sarah is paying herself as an employee. We have based on salary, right? We don't calculate NIC on dividend, so it's only on the cash earning, big salary here. So we have 30,000 money, the lower limit, and that will be at 12%. Give her that. Then don't forget the company, that's the employer, because Sarah now is an employee. So the employer will pay some NIC on behalf of Sarah. So for the class 1 employer, have no upper limit, but a lower limit. So that will take all his earnings, which is still within the 50,000 limit. But assuming it's more than 50,000, you take all the amounts, because class 1 employer has no upper limit. So you take all the earnings less 95 with the lower limit at 13.8, and that gives us this figure. Then so that's the NIC the employer will pay. Then we come to do our corporate tax. Now the company as a separate legal entity will pay tax. So this the company's profit before the director's remuneration. Then they have to less the salary they pay to Sarah. It's an expenditure they have to less. The company also pay class 1 employer NIC. That's from here. We need to deduct that as well. So we deduct. Okay, so you can see that here we say equal to, and we just went and hit. So all the figures are referenced from other areas. Okay, this one we just type straight. But this, before we do the calculation here, we just reference or link to this, and we have that as minus over there. Then when we less this, you see we less this NIC because it's an expenditure for the employer, the company. So that's how come we are lessing it from here. Then our revised TTP will be so much at a rate of 19%. So that these are the liabilities if the company or the business is incorporated. So we look at the question. We were told that if you trade on self-employment, you are going to pay a liability of what? 11,304. So we have the 11,304 under self-employment. Then total tax under incorporation. Under incorporation, you have to sum all the liabilities calculated. So you can see this liability is the various calculations we did. Okay, this 1, 2, 3, 4. So this is the income tax, the class 1 employee, class 1 employer, and the corporate tax that have been added to give it the 12,651. So when we compare, you can see that the liability under incorporation is more than when we were trading under self-employment, right? So here we say what? Increase in tax due to incorporation. So there has been an increase in tax of so much due to what? Incorporation. And yes, so that's it. That's it. Tax have gone up because of what? Incorporation. Okay, so let's so that's it, and the answer for the A part of that question. And then the B part, we have to advise as to why her proposed basis of extracting profit from the new company is not optimum for tax purposes, and suggest how to fix how the mix of directors' remuneration and dividend will therefore be improved. Okay, so here we can see that when she incorporated a business, her tax has gone up. So can we have any advice? So here this our recommendation that the relatively high cost of Sarah incorporating her business arises because of her salary attracting both employee and employer NIC. So you can see that this same 30,000, you calculate class 1 employer on it, you also calculate class 1 employee on it. So we have 2 NICs we are paying on the salary, and that could have contributed toward the increase in tax. When she was operating under self-employment, she will pay class 2 and class 4 NIC. Okay, and class 2, which is not based on the profit. So the only NIC that will be subject, the profit subject to be class 4. But here, her salary is attracting both employee NIC and employer NIC. Now, one way we can improve or reduce the tax under this option is that we can restrict the salary to 9,500. Don't forget, the lower limit for these two NICs is 9,500. So if our salary is not more than 9,500, in that case, there will be no NIC. If our salary is within the lower limit, or we take up to a maximum of 9,500, we have no NIC to pay. Right? So we can restrict the salary to what? 9,500 and rather go for a corresponding higher amount of dividend. Right? So you see that dividend didn't attract any NIC. So we can rather take small salary and then push the rest of our income through what? Dividend. You know, dividend will not attract any NIC. And again, dividend has a lower income tax rate than what? Than salary. Salary is being taxed at, I think, 20% and 40% and 45%. Dividend, even some part may go for 0%. We have 7.5 instead of 20%, 32%, 32.5 instead of 40%, and I think 38% instead of 45%. Right. So it's better to push much of the income for tax purposes through dividend and something small from what? Salary. And that will improve our tax position. Right. Any question on this one?
No, sir.
You are okay.
Sir.
All right.
No, please.
Okay. You have a question?
No, please.
So we can move on. Can you move on?
Yes, sir.
Okay. Okay, so let's look at this one too. Number 32. You know. So the introduction says that Simon on CITIPRO, that's the beginning of the year, he commenced employment. So he commenced employment from the beginning of the year. And then on 1st January 2021, he commenced a partnership. So that's trading activity with A. And they prepare account towards 30th April. So with that, for the partnership business, they traded for 4 months, January 2021 to 30th April 2021. And the following information is available. So we have information under employment, we have information under the partnership, and we have information on property income. And we have to calculate his taxable income. Taxable income means that we have to group all his income and less our personal allowance, and that ends it. Track all the sources, put them together, get your total, take off personal allowance, and that's it. All right, so let's start from employment. So you have to determine the total income from employment. So she has salary of 23,940. So we pick that. Throughout the year, the company provided him with living accommodation, so there will be accommodation benefit here. The company has purchased the property in 2008 for 89,000 and was valued at 143,000 as at the date they gave to him. The value of the property, the annual value was 400. So when it comes to the accommodation, the first thing you look out for is higher of rental the company is paying on this accommodation and the annual value. Now, in this question, the company bought the property themselves, so there's no landlord who will be paying rent to. So you just go for the annual value. So our first benefit with accommodation will be the annual value of 4,600. So we pick that. After that, we check if the accommodation is expensive. Now, the accommodation is expensive where the cost is more than 75,000. Now, this question we're told that the cost is what? 89. So this is more than 75. So there will be additional benefit. So we're also giving market value. Then the question now will be, do we use the original cost of 85 to calculate the additional benefit, or we use the 143,000? Now, we'll use the market value when the date of purchase of the accommodation and the date accommodation have been provided to the employee is more than 6 years. So this has been purchased in 2008, was given to the employee in 2020. So the interval is more than 6 years. So we cannot use the historical cost. We'll use the market value to do the additional benefit computation. So how do you calculate the market value? You take this, how to calculate the additional benefit? You take the market value here minus 75 by the official rate of interest. So we are going to have something like this. So we are doing workings here, workings on the employment income. So we have our salary. Then for the accommodation, we pick the annual value, like I said. Then as we check, we said it's expensive, and based for analysis, we use the market value to calculate the additional benefit. So we take the market value less a limit of 75, but then the difference multiplied by the official rate of interest, which is 2.25. So when you do that, you get 1530. Right. So that's it for the accommodation. Then again, when you conduct, I said the property was furnished. So mean that there's a furniture. The company provided furniture. So furniture at a cost of 9,400. Now, when you are using the company's furniture, there's a benefit. The benefit is 20%. Okay, so all assets that belong to a company, apart from the accommodation and motor cars, or where it's specifically stated, the benefit is 20% on the cost. So here on this furniture, the cost is 9,400. The benefit will be 20% of that. And they said this was provided, the accommodation was furnished since 2020. And he came in since April 20. So look at that, furniture was even there before he came. So he used it throughout the year. So a full year benefit will be assessed. So for the furniture, the 9,400 by 20% will give us 1,880. Okay, then we move on. The third item here is that on 1st December, the company provided him with interest-free loan of 84,000. Right, so they gave him a loan which he didn't pay interest. So normally, when the loan is provided, interest should be at the official rate, which is 2.25. He didn't pay any interest over there, and it was given on 1st December. So within the tax year, he might have used this loan for how long? December, January, February, March. So that's 4 months. So the 4-month interest will be assessed. He didn't pay, assuming he had paid any interest, would have deducted from whatever interest would calculate the market value. So here, our loan benefit, you take the loan amount by the official rate, then we multiply 4/12 because the loan was provided for only 4 months. So he should be paying this interest, which he didn't pay any part of it. So that's the interest accessible on him. And that's it for employment. So our employment income, we are getting so much from employment. So we look at the other category of income. The next component of income is from partnership. So partnership, that's a trading activity, that's like self-employment. So that one will determine the profits from the self-employment, and then since they are in partnership, we will now share the profit for them. Then we get Simon's share for our calculation. So over the 4-month trading, they traded for 4 months. They traded for 4 months, and the profit was 29,700. And this figure is before capital allowance. So it means that we have to less capital allowance from this profit. Now, so I think the 2 is on the item for capital allowance. The only item for plant and machinery owned by the partnership business was a motor car, and the cost is 25,000 and was purchased in February 21. The motor car has sealed to emission of 125. This 125 means that it will qualify as what special rate pool asset or special rate pool motor car. which will go for, I think, 6% WDA, right? And it's used by A, and 40% of the mileage is for private journeys. So the motor car is not used 100%. This is self-employment business, and so far as one of the owners is using the car privately, the allowance will be limited to only the business percentage of business use. So 40% private, that means 60% for business. So whatever allowance we calculate on the car, we will only take 60%, which is for the business use. And I said we are doing so because this is sole proprietorship. If you are dealing with a company, private use of a car when it comes to capital allowance has no effect. But for sole proprietorship business, private use will limit the allowance you get on the car. So we'll take the cost of this, since it will fall within the special rate, we'll use 6%. Then we'll adjust. Don't forget, we'll adjust by the number of months. Number of months here, we are paying 4 months. Okay, so times 4/12, and also by the 60%, which is the business use of the car. So in our solution here, we say that for our partnership, when it comes to the capital allowance, we take the cost of the car, the 6% of EDA, multiplied by 4/12. They traded for only 4 months, times 60%, which is the business use of the car, and that gave us an allowance of 300, which we need to deduct from the profit. So this is 29,400. That's, we adjusted that for capital allowance. Then don't forget, I think there's additional information. The last portion is that profit are shared 40 to S. So S is the subject here, 60 to A. This is after paying annual salary of 6,000 to A. So it means that before we share the profit, A will be taking salary of 6,000 for a year, but we didn't trade for a year, so we have to apportion the salary that will go against the 4-month trading period. So we let the salary that goes to A times 4/12, 6,000 for a year, so 4/12 will give us what? 2,000. So we let that will be left with what? 27,400 to share. Now, because we are concerned about Simon share is 40% of this profit, and that will give us 1090. Okay, so here what it means is that for Simon, his profit is what? 10,960, and that profit is from 1st January 2021 up to 30th April 2021, which is 4-month trading period. Since it's the first period of trading, we have to do an assessment, based on assessment, to know how much of profit is accessible in this year, current year. So we look at the tax year 2021. He commenced trading, so we apply the commencement rule. Date of commencement 1st January 2021 up to 5th April you meet. So we can see to 5th April, and that's giving us 3 months. But his share of profit, which is the 10,950, is for a 4-month period. But our assessment shows that we only need 3 months. So what we have to do here is to multiply his share of profit per assessment. We need 3 months for this year, so 3/4-month trading period, and that gives us 822 accessible for this year. So that's for the trading profit aspect. Will be assessed on 822, employment of 32 something. Then I think we also have the property to look at. So property income, he let out a furnished property throughout the year, a monthly income of 660. Okay, so we'll multiply 660 property income. So we have 660 by 12. Okay, and then we have some expenses to consider here. During the year, he paid council tax and water rate, allowable expenditure 1320. And then he replaced the washing machine. Now the old one that was replaced was sold for 70 and was replaced by a washer dryer costing 970. The cost of a similar washing machine would have cost 730. So here, now when it comes to replacement of domestic items, it's an allowable expenditure. However, we said the replacement, since it's a replacement, it should be of a similar item. You replace a washing machine with a washer dryer. They are not the same. That's an enhancement. So we'll not consider the cost of an enhanced item. So in that case, in the market, a similar washing machine would have cost about 730. So we'll use the 730 and not the washer dryer, because you are replacing washing machine, not washer dryer. So the cost of the washing machine, similar washing machine, would have cost 730. So we'll use the 730. But the old one you sold, you've gotten what? 70. So what will be the net cost? We should spend 730 less the inflow of what? 70. So there'll be a net cost of 6. So that's this. We spend that negative 730 and we get an inflow of what? 70. So the net cost will be 660. So that's it for the property income, and we get 5940. So when we sum all this, so we can now group them at the top here. So for employment, the trading profit, the property, we get a total of 46,740. We less our personal allowance and get our taxable income. So that's how we go for the question, get a taxable income. And there's a B part that says state 2 advantages of the partnership choosing 30th April as the accounting date rather than 5th April. So advantages of choosing 30th April as your accounting date and not 5th April. This will prolong the interval between when profit is realized and when the related taxes are paid. So here, 30th April means that profits are made early within the year, because the year will start from 6th April. So if you generate your profit on 30th April, that's within the first month of the tax year. And you have to pay tax, when the year ends, and even after that, 31st January after the year end before you pay tax. So you can see that the date on which you realize the profit and when you will pay the related tax, the interval is very long. Then it also gives enough time for tax planning. So here the profit is made early in the tax year. So by the time the tax year ends, you can make certain investment, right, or certain decisions that will help toward to reduce your tax liability. You have enough time toward to plan your tax before the end of what the tax year, right? So that's it for number 32. Okay, so I think our time is up, and that's how far we can go for today. If you have any question, you can ask before we close. Are you with me? Do you have any question?
Jonathan, sorry, my network. No, thank you.
You have no question. Okay. Dennis, do you have any question?
No, sir.
All right. Okay. So I wish you all the best. And I think in course of the week, I think Thursday or so, you will have, that's going to be purely exam strategy, right? So some of the strategies and issues we have to consider when we are answering questions, right? So I think it's not just about you learning and understanding some of this. It's about you also getting the strategy for the examination. You have to plan your exam well, because find your time management, how you approach the question. I think those are also issues we have to address. So I think that will be our last discussion, and I believe it's going to be this coming Thursday. You'll be informed as to when that will take place. So that one is not really going to be solving a question. They are just going to look at how the skills we need to master to be able to pass, right? The exam strategy we need to adopt, right? So I think that will be all, and God willing, we'll meet on Thursday. So I wish you all the best.